Welcome to SK Wealth Management Solutions and Knowledge Podcast Episode 6, where we take an integrated approach to improve your financial lives. My name is Matt Nealand, and I'm the Director of Investments at SK Wealth Management. In our last episode, we began the discussion on the impact of the new Tax Cuts and Jobs Act. Our focus was on how the act will impact individual taxpayers. In this episode, we will shift gears and discuss how the act affects small and medium-sized businesses. The act has been touted as a clear win for U.S. businesses, and while that might ring true for those that stand to pay much lower corporate tax rate, the benefits for America's small and medium-sized businesses are a little more complicated to decipher. I will be joined by a panel of tax experts, including Michael DeCataldo, Managing Partner and Head of the Tax Group, Sue Windle, a tax partner, and Ann Pisaturo, a principal in the tax group at Sansiveri Kimball and Company, LLP. Thanks for joining me to help us all better understand the tax changes and how they will impact tax planning for businesses. After reading through the changes, I do not see any of the tax simplification that was talked about during the negotiations. But there are plenty of calculations and strategy decisions business owners need to consider. To get started, the Tax Cuts and Jobs Act made many changes to business taxes. What are some of the more significant changes that affect businesses?
Well, Matt, in the C Corporation area, the biggest change was the drop in the corporate tax rate from 35% to 21%. Also, the corporate alternative minimum tax was repealed beginning in 2018. The dividend received deduction was lowered, and the NOL deduction is now going to be limited to 80% of taxable income. The Act eliminates the carrybacks, but allows unused NOLs to be carried forward indefinitely. What this provision will actually do is result in 20% of current year taxable income being taxed, where in prior years the NOL could have offset 100% of that taxable income.
For those of us who don't know, what exactly is a C Corporation, for those listeners who do not understand the difference?
Matt, a C Corporation is a common type of business organization that is treated as a separate taxable entity from its owners. Some of its characteristics are limited liability, no restrictions on ownership, and the ability to have more than one class of stock. But the major difference is that a C Corporation pays its own taxes at both the federal and state levels.
Sue, what are some of the other changes you see?
A major change is for flow-through entities, the 20% deduction for pass-through entities, and for non-corporate taxpayers, there is a new excess loss limitation.
And then for all entities, they can take advantage of some of the incentives relating to depreciable assets. The new tax law provides for 100% bonus depreciation for qualified assets placed in service between September 27, 2017 and January 1, 2023. The limits on luxury auto depreciation for the first year increased from $3,160 up to $10,000 before considering bonus depreciation. And the Section 179 expensing amount was almost doubled from $510,000 to $1 million, with a corresponding increase in the phase-out threshold amount from roughly $2 million to $2.5 million.
Those are some of the increased deductions. However, some deductions have been eliminated or reduced. Certain business expenses for entertainment, amusement, or recreation activities are no longer deductible. Also, the domestic production deduction has been repealed, and business interest expense deduction will be limited to 30% of business adjusted taxable income for certain businesses.
Is that pretty much it for business changes?
Well, no, Matt. There were a number of changes designed to help small businesses, which is defined as a taxpayer with average annual gross receipts of $25 million or less. These changes were enacted to simplify small business accounting and make it easier for them to stay in compliance with IRS filing requirements and regulations. The reform allows the use of the cash basis of accounting, even when the accrual basis would seem more appropriate. It eliminates the need to account for inventories under the burdensome Section 471 rules, regardless of entity structure or industry. It also exempts small businesses from the uniform capitalization rules. The Act no longer requires that certain small contractors use the percentage of completion method to determine their taxable income, and it exempts businesses from the new interest expense limitation provisions that Sue mentioned previously.
Could you narrow down the list to what you believe are the changes that will have the biggest impact on most business owners?
The two biggest changes that will have the most impact are the lower C corporation rate of 21% could have a direct impact on how many businesses operate in the future, and the 20% deduction for flow-through entities such as S corporation, partnerships, LLC, and sole proprietorships. Many taxpayers will be considering whether they should change from their current flow-through entity to a C corporation. This decision to convert to a C corporation will be impacted by whether a business qualifies for this 20% deduction.
Can you help me understand this deduction and why it was enacted as part of the tax reform bill?
Matt, the biggest reason this deduction was enacted was to help reduce the gap between the new C corporation tax rates and those rates that apply to individual taxpayers. While the C corporation tax rate remains at this reduced 21%, corporations will have a competitive advantage. But it's also important to remember why most new businesses were choosing to operate as flow-through entities instead of C corporations. With the C corporation, there is double taxation. This means that earnings are taxed first at the corporate level, and then a second time at the individual level when those earnings are later distributed to the shareholders as dividend.
And that's an excellent point. With the double taxation, with the older rates, with the maximum rate at 35%, the combined tax at the corporate level and the shareholder level could exceed 50%, and that is only at the federal level. It does not impact the effect of the state taxes. Now with the lower rate, there is still approximately a 39 to 40% tax rate on the combined income. So the 21% tax rate has to be factored in with the tax when these earnings are ultimately distributed to the shareholders.
Can you tell us a little bit more about this 20% deduction?
Matt, this is probably one of the most complex areas of the new tax law. So much for filing your income tax return on a postcard. The basic premise is that certain flow-through entities will be entitled to an additional 20% deduction against their owner's taxable income. This deduction is not allowed for every type of business, as most personal service businesses will not qualify.
What type of business is considered a personal service business?
A personal service business is one where the value comes from the expertise and knowledge of the individuals providing the service. For example, accountants, lawyers, physicians, actuaries, consultants, financial planners, and even investment advisors are just a few of the businesses that do not qualify for the deduction. The definition of a personal service business is very broad and can catch many owners by surprise.
So if a business is eligible to take this deduction, how does it work?
This is a very complicated calculation and is specific to each client's unique facts. You need to know the company's qualified business income, its salary, and the unadjusted basis of the business's qualified property. First, you calculate your qualified business income, or QBI, and multiply this number by 20%. Then you determine the wage limitation, which is 50% of your share of the flow-through's wages. And finally, you determine your share of the second limitation, which is 25% of flow-through wages plus 2.5% of the unadjusted basis of your qualified property.
Boy, there's a lot to this. Can you give us an example of how all this works?
Yes, Matt, I can give you an example. It may make your head spin a little bit, but I'll try to keep it as simple as possible. Let's assume a business operating as a sole proprietorship and that the business has $500,000 of qualified business income, $350,000 of W-2 wages with respect to its qualified business income, and that the business has $1.5 million of qualified property. We would begin the calculation by first calculating the tentative deduction, which would be 20% of our qualified business income of $500,000, or $100,000. We would then calculate the two limitations to determine the higher of the two. The first is $175,000, which is 50% of the W-2 wages of $350,000. The second limitation is $125,000, which is 25% of the qualified wages of $350,000, and 2.5% of the $1.5 million of qualified property. We then take the higher of the two, the $175,000, and compare it to our tentative deduction of $100,000. If it is higher than the tentative deduction, we're done. The tentative deduction is the amount that we can take. If it's lower than the tentative deduction, then we're limited to that lower amount.
Can you quantify how much this deduction is worth to somebody who qualifies?
This deduction could result in up to a 7.4% reduction in an individual's tax on qualified business income, narrowing the gap between the C corporation tax rate and the tax rate individuals would pay on their business income. But it's important to remember that this special deduction expires at the end of 2025.
That begs the question, why should someone consider changing to a C corporation?
If a company is reinvesting its excess profits back into the business by purchasing additional equipment, hiring new employees, expanding into new markets, and are developing new products, doing business as a C corporation could make sense. If there is no intent on selling the business in the foreseeable future, the time value of the double tax upon sale could be mitigated. The longer you can avoid the second level of shareholder tax, whether on current earnings or upon a future sale of the business, the more sense it makes to be a C corporation.
And what can be a downside to converting to a C corporation?
Well, Matt, one of the downsides can occur when it's time to sell. Most closely held family businesses will have a hard time finding a buyer who is willing to purchase their stock, so they end up selling the assets of the business. When those assets are in a C corporation, that results in double taxation. Now, the new lower corporate tax rate reduces the overall tax cost of selling assets in a C corporation, but it's still more costly than selling the assets of a flow-through entity.
That's great. And to wrap it up and move on to the next step, what are you telling your clients, and what are the next steps for those clients?
Well, Matt, we are working with our clients on an individual basis, reviewing their specific situation and developing a plan of action based on their unique facts. For most of our clients, we are reviewing whether it makes sense to keep flow-through taxation and then to try to maximize the new 20% deduction. As a matter of fact, I spent the morning in Boston with one of our larger S corporation clients going through this exact scenario. We compared S corporation flow-through taxation without the 20% deduction, with the 20% deduction, to converting to a C corporation. We had a good 2-hour conversation, which we thought was very productive. Changing to a C corporation may make sense for a client who is reinvesting profits back into their business through capital acquisitions, employee development, and market expansion, and has no intention of selling the business anytime in the near future.
Thank you all. This was very helpful. It's clear that the benefits and impact of the Tax Cuts and Jobs Act can be different for each business and each situation. This is going to keep tax professionals and business owners very busy as they begin their tax planning process. Thank you all very much for listening to this episode of SK Wealth Management Solutions and Knowledge Podcast. Stay tuned for our next episode when we will discuss the wild ride in the financial markets and, more importantly, strategies to cope and prosper. You can subscribe and listen to our podcast on iTunes, Stitcher, Google Play, and iHeartRadio. We also provide links to our podcast on our websites, skwealth.com and sansiveri.com. Have a great day.